And I love doing these things at nighttime, man. It's just a good mood. It's a good night to talk about Bitcoin. Every night is a good night to talk about Bitcoin. I'm particularly bullish for this particular episode. We've got Preston Pysh and Andy Edstrom with you. Before we dive in, let me talk to you a little bit about what we do at Swan. We have built the easiest and best way for you to accumulate Bitcoin with automatic recurring buys. It's super simple. Think about Bitcoin like a 401k or a payment on your mortgage, regularly, consistently buying some Bitcoin, saving it up as an investment in your future and our future, collective future. The process is super simple. You just connect your bank account. We'll auto pull money from your bank account and buy the Bitcoin, and then you can automatically draw it. That's it. 1, 2, 3. We have super low fees. We are up to 80% lower on fees than Coinbase, which is, just crushing Coinbase. We have up to 57% lower fees than Cash App as well for recurring buys. So I don't think there's any reason to be stacking anywhere else with your auto recurring buys than Swan in the United States. And in case you missed it, we are launching daily buys. We've had massive demand for daily buys since we launched the app, launched the service. It's right now the most often, or the fastest or most often you can buy Bitcoin is weekly. With daily, you should be able to catch those dips even better. That's launching soon. To get into the first cohort, the first group, the beta group of daily buys, go to swanbitcoin.com/daily buys and sign up there. All right. Let's dive into this one with these two fine gentlemen that we have here today. Preston Pysh of the Investors Podcast Network. How's it going, man?
What's going on? Good to be here.
Just ready to chill and talk some Bitcoin. Andy, author of Why Buy Bitcoin, financial advisor. Welcome to the show, man.
Yeah, hell yeah. Thanks for having me. I'm still jacked up on Preston's last TIP episode, by the way, which was an all-star cast, Luke Roman and Lyd Alden and Jeff Booth. And yeah, I'm still coming down from that one.
I'll tell you, when I was done recording that, I went into the kitchen and my wife was there and I said, I feel like I just talked to like 3 of the smartest people on the planet right now. Cause he's, right. And I also shot Jeff Booth a text and I said, yo, Lyn Alden is she's kind of at a different level, man. She is really intelligent. Like, I feel like I've interviewed a lot of people through the years, and I'm telling you, she is insanely intelligent.
Yes. Yeah. Yes. She is, and so are all of your guests and the host too, of course. So I'm excited to get into it with you. And I'm almost celebrating, also just FYI, a week from today will be the 1-year anniversary of this guy. So I couldn't help myself.
Congrats.
Yeah.
That's awesome.
People don't know how much work it is to put a book together. It is a lot of work, man.
Yeah. You're working on one?
No. Not only no, but hell no.
You're too smart. You're too smart for that.
Dude, it's just so much work. It's a lot of, and I don't like writing. To be honest with you, I don't enjoy writing. So it's a chore for me.
Yeah. Hey man, we each do what works for us, and we try to contribute our 2 cents to the whole process. So it's great to be on with you.
Yeah, great to be here with you as well, Andy.
I am, like Preston, a talker as well. I like to talk about stuff. Let's talk about it. So let's get into it then. That's what we're here for. Let's talk about the Jerome Powell speech. It's coming up tomorrow morning, 9 a.m. Eastern time. It's said that it's, we're expected to hear some historic changes in, an outlook or policy from the Fed. Of course, it's, the language that we're going to hear tomorrow in the speech is not going to be so arresting as the titles, the headlines we've been reading about this speech. It's said to be expected that we'll get a moderate inflation overshoot during this recovery phase of this cycle. Andy, what are you expecting to hear tomorrow, man? And, if we hear that, how do you think it's going to affect the markets and Bitcoin?
Yeah. Couple things. So the first thing is, as part of my business, as you mentioned, I'm a wealth manager. We subscribe to a few sources of research, right? Including some macro ones. And I don't want to throw anyone under the bus, but let's say that I got a note in recently from one of our research providers talking about how, they probably won't announce yield curve control explicitly, but they may announce a new policy, which is symmetry in the inflation target, which is to say, for every year they undershot on their stated target of 2% of inflation, they ought to overshoot. Now, I haven't gotten my head around this because one of the things I included in my book was the Fed has been going on record already in the FOMC minutes and their reports talking about how the target is symmetric, which, they don't state it explicitly, but the implication is that if they've been undershooting on PCE or CPI for a while, according to their measurements, then they ought to overshoot for a while. So I think that's what some people are expecting, is they'll maybe talk about symmetry of the target. And to me, that's not news, because they've already been publishing that in their notes, but that's one idea or one angle. The second perspective I take is zoom out, right? Who cares, what Powell says at this meeting or in this speech, the next meeting, a few meetings from now. We know, Preston knows, where this thing is going, right? Because we know what the debt levels are. And so what happens, week to week, month to month, it'll matter short term in terms of, where gold goes, where treasuries go. There'll be some noise and fluctuations. I'm not as focused on those. I'm focused on the big picture in the long term and where it's likely to play out over a series of years. So I'll leave it there.
Yeah, my only comment is they're saying that they're going to let inflation go, but at the end of the day, they can't allow for rates to go up. Like, they just cannot, from a fiscal standpoint, especially at the rate that we're issuing money right now. Is they can't afford for debt yields to go up. And so whenever I think of somebody saying, "Oh, we want inflation to come in," well, if inflation's 3%, the price of debt is a premium above whatever that is, right? So they're saying one thing, and then on the fiscal side, there's the elected officials are spending at rates that are accelerative and actually require yields to go significantly lower than where they're at in order to keep this thing, I don't even know what to call this anymore as far as what the economy is on a global scale, going and rolling. So it's an interesting narrative that he's saying. I think, if I was going to summarize what he's trying to say is we're conducting an experiment. We're going to print as much as we can to see if we can actually even get inflation to occur, is kind of how I guess I'm reading this announcement tomorrow. And when you look at, when you go back to Paul Volcker and his big moment back in the early 80s, when he, was basically saying, I'm going to get inflation under control and I'm going to, do everything I can to do that. You have, it seems like Jerome Powell's trying to do the exact same thing, but in the inverse, like a 180 of that. Yeah. And like, he's
the anti-Volcker.
Yeah. It's like the anti-Volcker speech. And what's crazy is history is not going to judge this moment in time like Paul Volcker was judged. Because, you talk to any central banker, you talk to any person in finance, they'll tell you that Paul Volcker was basically the savior of inflation and got the economy functioning normally again and all these things. And I think Jerome Powell's trying to have that moment right now. And I just don't think that he realizes that once inflation shows up, it's not going to just show up a little bit. It's going to show up in a way that they just can't even imagine. So it's going to be interesting.
Agreed.
So I'm starting to I am learning about money and about finance along with a lot of other Bitcoiners, as we are being taught what money really is, coming from our Keynesian roots, which is, all that most of us know about money. So I'm kind of piecing together how this all works. And the Fed will basically, when we say print money, they will basically put assets on the books of banks, and then banks have to lend it out for it to get into the real economy, right? So, or you can just like give money in UBI, right? UBI style. But point being, you've got to get money out into the real economy, the M2 supply, as it's called, I guess, in order for you to eventually see inflation. Is that a correct understanding?
Yeah, I don't know if you want to take that or you want me to take a shot at it.
This is the best way I can explain it, is to give you a handoff to something that's going to explain it way better than I can verbally. You have to go and watch Ray Dalio's video. It's titled "How the Economic Machine Works." Ray, for people that are listening and don't know who the guy is, he's, anyone in finance will tell you that this guy is he runs the biggest hedge fund in the world. During the 2008, 2009 crash, Ray was up in double digits in the green when the rest of the market was down 50, 60%. He understands how all this functions. Go watch this video. It's a 30-minute video. I tell you, it's probably the best lesson you will ever get on how the economic machine works, and it will do a fantastic job of explaining a lot of things. If I was going to summarize this video for you real quickly, you got to think about what that credit and real baseline dollars spend exactly the same. So if you pull a dollar bill out of your pocket, that will spend the exact same way as if I went to a bar and I said, hey, let's start a tab, right? Give me the beer and I promise to pay you at the end of the night. I just effectively created money when I did that. Even though there was no money exchanged at that moment in time, there was money creation that occurred. So when you look at the credit that was in the system at the end of the 2008, 2009 time, a majority of that was a promise that I will pay you at the end of the night kind of thing, right? A majority, if you were going to take all the promises and you'd add them with the monetary baseline, like hard money / currency that was in the system, and you'd slap those two things together, the promises were way more plentiful than the baseline money. And so what has effectively happened since 2008 is that all the central banks have done is they've come in with QE and they've swapped monetary baseline money for currency, because you can get into a debate on what is quote unquote money, right? But let's just say they swapped the currency for the promises, and they did this in a major way. But the problem is when you do that, you're funneling all that money into the people who owned the promises. Okay, so like if you owned a bond, you're now getting this first cut of this freshly printed money, and they're basically saying, I'll buy that at pretty much any price. They kept bidding it. That's why the yields went down, down, down. And now you're at a point where the rates are getting polarized. They've swapped so many freshly printed money for these promises that they've pushed the yields down to nothing, right? Yeah. And now you're at this end game, and now that's why everyone's saying, oh, well, we're going to do MMT, which is just basically saying, hey, we're going to try this crazy science experiment and push rates below zero, and we're going to go in the negative territory, right? So that's the best way I can explain it. But I promise you, this Ray Dalio video that you can watch for 30 minutes is going to graphically show some of this to you. It's going to explain it way better than I ever could. And Andy, I'm sure you have some key additions to some of those comments.
Yeah, so I love that you mentioned the Dalio video, how the economic machine works, because true story, okay, we're reaching over to my Wayback Machine here and turning the crank. 2016, I sent a memo to all my clients, and it was a couple of messages. The first was, watch this video. And I included a link, and I said, watch it, and then watch it again, and when you're ready, talk with me about it. So 100%, I agree with you. We turned our clients onto that about 4 years ago now, and it is spot on. Second thing we told them was, because interest rates are so low already, and they can't go up, as Preston pointed out, right? Because if they did, you'd have a depression. Because of that, basically future investment returns in general are going to be lower than they've been in a very, very long time. Like in probably your entire lifetime, right, dear client? The double-digit annual returns in the stock market globally are a thing of the past. By the way, we've basically seen that in U.S. stocks, or specifically in the internet giants. That's another topic of conversation. But so far, it's played out, lower returns. So that's one thing. Spot on. I agree about the idea of creating credit. Dalio talks a lot about this. It is crucial. I actually remember specifically from that video, if you watch that video, one of the things you'll see, he's got a graphic. He's got base money in the US, and the number used in the video, I think, is about 3 trillion. And then he zooms out, right? There's like 3 stacks of dollar bills, and the video zooms out, and there's 50 stacks of dollar bills in the background. And I think the ratio at the time in the video is about 50, right, to 3. And what he said was, there's $3 trillion of base money, and on top of that, there's $50 trillion of credit, right? And that was just in the US. So Preston, spot on, right? The multiple of credit on top of base money is enormous. And that notion of creating credit, this is what James Grant, He's been around Wall Street forever. He's been a gadfly. He's been a gold bug for longer than I've been alive. Okay. He talks about credit being, quote, money of the mind, right? It's this idea that, yeah, if you transact in money, that's the endowed asset. As soon as you create credit, like Preston described, now you've time shifted that transaction or the settlement of it from the present in terms of money to the future. You've created that debt that you promised to, to settle in the future. And so this is crucial to understand the money supply. Now, when you're talking about, the Fed printing the money and pushing it into the banking system, yeah, so far, the story of the last few years has been that creating the dollars and trying to push them into the system hasn't really, it hasn't really created a lot. It hasn't created excess credit incrementally. Now, I think it'll be interesting to see what happens now that some of the rules have changed. Okay, it used to be that banks, when they bought treasuries, had to reserve some capital against those assets, right? Guess what? They don't have to anymore, at least as of a few months ago. So that requirement is gone. And the second thing that's gone away is interest on excess reserves, right? It used to be that the banks could park money at the Fed and earn 2%, no risk, right? Free return. You put money at the Fed as a bank, you get 2% annualized, and there is literally zero credit risk associated with that. So why wouldn't you do that? Well, now the interest on excess reserves has been taken almost to zero. And so it will be interesting to see how the banks deal with that, right? Will they push out more loans to the corporate sector? Will they push out more loans to the housing sector? I can tell you the housing sector is pretty hot right now. I refinanced my mortgage. I got, like a lot of clients who've done the same. So the ground is moving and shifting with respect to the credit creation on top of the base money. That's how I see it these days.
Yeah.
Hey, Brady, I just want to just say a moment for Matt D'Souza, who passed away. It was a close friend of mine. I'm pretty sure anybody that's been in the space for any amount of time knows Matt. And I was crushed seeing that, because I didn't know that he was struggling right now. And what a great guy. I feel bad that I couldn't do more. The way I found out was just kind of crushing, to be honest with you. I feel terrible.
Yeah, man, I appreciate that. It's terribly sad news today, the loss of Matt D'Souza. He was CEO of a couple of companies in the space, most recently of a important Bitcoin mining company. A very smart rising star in the industry, so definitely will be missed. Yeah. Thanks for taking a moment.
Yeah, I want to add the 2 cents. The lens that I really appreciated that he brought to the industry was what you just mentioned, Brady, was insight into the mining space, which is notoriously sort of the most opaque. We all sort of wave our hands. Many of us wave our hands about what's going on in that part of the ecosystem, and it's so critically important to the whole picture. And so I didn't know him personally, but his intellectual contributions will be missed.
Yeah, absolutely. So, getting back to this discussion about just how money works and how what we can expect in the future with these changes, right? I want to talk a little bit about indicators that you guys are watching. It's something that Bitcoiners listening could keep an eye on, that kind of guide or give us a little insight into what's going to happen in the nearish future. A couple that have caught my eye just from watching charts on the St. Louis Fed website and stuff. One is the velocity of money, which has fallen off a cliff. It's been going down quite a bit steadily since 2008, but it's completely fallen off a cliff now. It's almost down. It's down below 1.1 for Q2 this year, which would be expected with some of the things that's going on. But this is alarmingly low. Going back to 1960, which is how far the data goes back in the St. Louis Fed, it's by far lower than it's ever been. And David Laurent on Twitter brought up another good one, the debt to GDP ratio. So he says that a study by Hirschman Capital shows that out of 51 cases of government debt breaking above 130% of GDP since 1800, 50 have defaulted. The only exception so far is Japan. So first of all, you comment on either of those indicators, please. And also, what other indicators are you guys watching to kind of keep a finger on the pulse of what's happening?
So I guess I'll start with Hirschman. Coincidentally, I went to grade school with him, with Brian Hirschman. And in fact, I hadn't seen him in, I don't know, 25 years probably, but I ran into him at a CFA like drinks event. I think it was 2 years ago. Actually, I think it was 2 years ago, when the book was still a glimmer in my eye, and back then I was still, I hadn't quite found true north on Bitcoin, right? I was still kind of dabbling in a couple other things, and it sort of surprised. I had a conversation with him, and it sort of surprises me that he's relatively dismissive about Bitcoin, at least as it relates to gold. I hope he'll come around. But I haven't, validated his research or done anything like that. But I have to agree that the history of fiat monies is not, it's not great, right? Basically, they all fail eventually, and the debt to GDP ratio, it matters. The second thing I'll say is, it's true we're basically at record levels of debt to GDP, excluding the unfunded entitlements, right? In other words, if U.S. debt to GDP is approaching what is it total? If you've got government plus corporate plus household, it's 350% of GDP roughly, and then the unfunded entitlements are about another 1,000%. So it's pretty mind-boggling, and when you add I don't think, because of the demographics, right, of the developed world, of the rest of the Western world, we've never faced this kind of a entitlement funding problem. Like, nothing in history, I don't think, even comes close. So my guess is that he's focused, or that, again, I haven't delved into the research. A lot of people do focus on the sort of outright debt to GDP. They talk about government debt to GDP, over 100%. Then you talk about, layering the corporate and the household, you get to 300+%, depending on the country. But that's, kind of where we are in the US, as well as much of the Western world. And then, you look at the entitlements, and makes your head spin. So I don't know, I'll hand it off there.
One of the metrics that I look at a lot is the total assets of major central banks. And I'm just kind of watching that the explosive trend that we've seen over the last 10 years is continuing, just to, just confirm that everything that we talk about most of the time, which is all this printing, is going to start manifesting itself in some way or some fashion. And we already are seeing it manifest itself, and I can get into some of what those things are. But so I look at that chart, I see that trend, and I look at all of the central banks combined. The Yardeni Research puts out a report on a daily basis. I think it's automated, but all they're doing is they're basically summing up all of those central bank reports and then dropping them onto a chart. It's a wonderful chart. You can just search Yardeni global central bank balance sheet, and it's the first thing that'll come up on Google. So I'm looking at that a lot, just to confirm that there's no change in that trend. In fact, it's demonstrating that the trend is accelerating. And then the other thing that I would tell you I pay even more attention to is just really kind of Bitcoin and the hashing. I pay very close attention to the fact that you're not seeing miners taking their processing power to a different blockchain or a different protocol. I think that's very bullish for the idea that I have the opinion that the miners set the floor of the price curve, and there's people that disagree with that opinion. I think that whenever you're seeing that price floor get set, I think what you're seeing is a structural limitation on the amount of Bitcoin that there is to be sold at that time. And I think that the miners play an important part in that. And I think as long as you have as long as you have Bitcoin as a commodity and you have the demand flow for the use of that protocol, I think that you're going to continue to see the miners set the floor. And I think that that's one of the reasons why I have such a bullish argument in the coming 12 months, is because based on that reduction in the flow, the whole stock to flow model I find valid. But I think it only continues to be valid as long as miners continue to bring their hashing power and all of their processing power to the Bitcoin protocol. And so if I would see a change in that, that for me would be something to pay close attention to. And we're seeing the exact opposite of that. We're seeing hashing more and more hashing power. In fact, we just hit an all-time high. So from my vantage point, all those fundamental indicators that I'm using to continue to have faith in the protocol and the direction that this is all going are all in the green. And the thing that I'm paying close attention to is as well is when you look at the stock to flow chart, and I personally like the 463-day moving average. I can get into that if you guys have an interest in talking it, but I like using that as kind of the stick or the measuring stick for the speed at which this coming 12 months is probably going to play out from a price standpoint. When you look at that 463 moving average during the last halving to the next, I call it price orbit, right? Typically the price didn't get below 20 to 25% below that 463-day moving average. And so what I found interesting is this price after the halving went sideways for a quarter, which is what we pretty much all expected. And then once the price was almost exactly 20% below that 463-day moving average that was moving out, that's when you saw the price just ramp up and take a run. We're seeing a price correction 20% below that 463 right now is around 10,700, 800, somewhere around in there. So I would suspect that would probably be the price floor that we'd see for this little dip that we're seeing right now. And I would expect the next run to jump up into the 14 or maybe even the 15,000 range as it's moving forward. So I'm just watching those metrics. I'm looking for that thesis to continue to play out. And so far it's been right on cue. I mean, it really has not deviated too far from what I expected from some of those metrics. And those are the things I'm looking at from a day-to-day basis, just to kind of make sure that everything's playing out as expected.
Yeah, that's well said. I just want to augment that. I mean, credit so far to 100 trillion, the NIM, who put out the model. But
Absolutely.
credit to you, Preston, for focusing on it and supporting it. And so far, it's playing out, right? I mean, there's definitely been some skeptics. I've kind of gone back and forth to be honest with you. I recognize it as, well, it's been right so far, and it's a decent number of data points. And we'll see what happens. But guess what? It seems to be playing out. It seems to be playing along the 4-year halving cycle. We're not too far off the quote unquote target, as you pointed out, and we're above the the likely floor. So it seems to be happening. The other thing I'd highlight too, which has nothing to do with sort of the endogenous metrics of the Bitcoin network itself, is the narrative, right, and gold. So it's partly a story of the dollar, right? It's partly a story of, I guess, the world recognizing that the Fed will print as much as it takes. And that's, the expectations piece. And then also the literal, the actual quantity of dollars that are getting, shoveled out the door to buy government debt. But the gold, there's hardcore gold bugs, and there's Bitcoin, enthusiasts, and then there's tweeners. A lot of the Bitcoin enthusiasts, I don't know, they have a little bit of beef with the gold guys. I love seeing gold rally because every dollar per ounce that gold goes up is market share that the Bitcoin's going to take later. So when I speak to my clients these days, I keep it really simple. Digital gold, and right now that is more than enough with respect to the narrative, with respect to the value proposition. Whether it's institutional money, coming in, Paul Tudor Jones, retail clients coming in, all that stuff. It just augments. It's a very strong narrative, let's say, that augments or echoes or reflects the fundamentals that Preston talked about.
Yeah.
Nothing drives psychology more than if people feel like their neighbor's getting ahead in front of them. And, that's my concern for the gold piece is, I think by Christmas, based on the stock to flow model and the stuff we were talking about earlier, as far as the expectations of where we should be at certain points in time, I mean, you should be making a new all-time high around that time frame is Christmas of 2020. And so if that's true, that means we've got 80, 90% upside from here, which is insane, right? Because I mean, there's not that many more months between now and Christmas. So to think that much of a jump could occur between now and then is going to be a dramatic narrative that I think very few are ready for, because there's no way in the world gold with its market cap, and I'm just going to use a generic figure, let's just say it's $10 trillion, which is 50 times higher than Bitcoin's market cap today. There's no way you're going to see anything remotely close to that on gold's movement. So it's gonna create a marketing buzz in financial news, and then you combine that with the backdrop of all this printing. And I mean, I don't care who you are in the market right now. You could know nothing about finance. You could be the world's worst financial student, and you know what's on that person's mind right now? They're walking around and they're saying, you know, they just can't keep printing money like this, can they? That's what they're telling themselves. And they don't know anything, but they're asking themselves that question. And I think that when you got people asking that kind of question, you have something that's been around for more than a decade. You have something that has done over 200% on the year, or whatever it is. It's going to attract a lot of interest. It's going to attract a lot of discussion, and it's marketing that you just can't even, if you had to put a dollar figure on how much marketing that would cost on a global scale to put out that much discussion, dude, you can't even imagine what the price would be.
And it's going to be great. It's going to be a very Merry Christmas. You heard it here. Preston Pysh called all-time high by Christmas time. I can promise you that if we get an all-time high in Bitcoin by Christmas, it's going to be a giant beef roast in the Edstrom household. And if we don't get an all-time high, it's still going to be a giant beef roast for Christmas in the Edstrom household. So there you go.
I mean, there's not any magic to what I'm saying. I mean, it's the math. It's the stock to flow model that is showing some of these timelines associated with the price. And when you look at the 463 day moving average on the stock to flow, and then you look 20% below that, you're pretty much at 20,000 at December 25th. So that's kind of why I'm saying that time frame. And I think that, you know, it might even be conservative.
Hope you're right.
Based on the stock to flow model. We'll see. I mean, this is like nothing I've ever seen in finance, where somebody can say something like that, which just sounds totally ludicrous for somebody that's not dialed into why that might be playing out. But at the end of the day, it comes down to math, and the math of the reduced flow of issuance of coins, combined with the people that have been in this space for this long, right, and are not selling their coins for nothing. Like, I've been in this space since 2015, and there are tons of people out there just like me. And let me tell you, after they've been riding this Bronco for as long as we've been riding it and seen what we've seen, like, these volatility moves that we're seeing right now are a total joke, right? This is nothing. I mean, if you were riding this Bronco in December of 2017 or, you know, earlier, and let's not kid ourselves, the people with big positions, they were. They were. So they're not selling their supply. I hate to tell you. I know I'm not. And so it's that reduction in the amount of flow that's being issued through the rewards is going to have a dramatic impact in the coming 12 months, in my humble opinion.
Agreed.
Damn. Stack those sats, everyone. And you know, this is another reason why I love Swan and why I love automatic recurring buys, and just getting as many hodlers as possible, you know, buying on a regular basis, you know, smash buy when you want to, right? You know, like when you're listening to Preston Pysh talk, but you know, that regular stack is important too, because you gotta think of it like a floor. It's like the hodl floor is what I like to call it. And every additional stacker just kind of raises that up a little bit more. So yeah, I mean, I think that's an important phenomenon that is going to be, you know, more impactful as the auto stacking gets more and more popular. So, all right,
Brady, can I just double down really fast? Can I just double
please.
down really fast? Like, so, I mean, today, this is like, I don't even know if you were going to bring this up, right? Fidelity, the big announcement that hit the news, right? So like $8.3 trillion in their customer funds, right? Let's just say they get 0.01% of that. I mean, and they're now saying they're going to do a Bitcoin fund only. I think that's how it was, printed in the article. I mean, this is nuts. We're not talking about something that's like some nerds go into a, some little affair in exchanging tokens on their smartphones. We're talking about like the biggest banks on the planet dedicating all their resources in a very trying time to this thing called Bitcoin. I mean, this is, if people are ignoring this, they're not paying attention. And if you think you can put this genie back in the bottle at this point, as you got companies dropping $250 million of their current assets on their balance sheet straight into Bitcoin instead of anything else, I mean, you're just totally kidding yourself.
I want to augment that too. Preston's right to focus on Fidelity. One of the magical things about Fidelity is Fidelity has huge market share, right, in the 401k business, right, in the retirement plan business. And the thing about the retirement plan business is a lot of that is self-directed, which means it's basically people working at companies, ordinary people. They're socking away some savings, some retirement money. They're stacking, today they're stacking stonks, but it's one thing for us to talk about, the institutional demand is coming. When is the pension money going to buy Bitcoin? Well, that could take a while. The hedge funds, the family offices are already in, the hedge funds are in to some degree, like the macro guys. I'm doing my best to bring in the wealth managers, but it's still really a retail driven phenomenon. And as soon as, a couple or a few $1 trillion of custodied 401k assets have a way to buy Bitcoin, and it may not be this particular product that Fidelity just made the filing for, but it'll be something, right? Fidelity, they ain't put in years and years of work on this thing, as Preston pointed out, to not basically win, right? To not win market share. They know that there is, pick a number, tens of billions, hundreds of billions of demand, nascent, embedded, pent up in that 401k channel. And it's just waiting for the product. It's just waiting for that proprietary Fidelity product to be slotted into that, into that chute for, millions of Americans, tens of millions of Americans potentially to buy to save for retirement.
I think the thing that's kind of exciting is the entrenchment that the companies are going to bring to it. So like the Microstrategy thing, I think this is just the tip of the iceberg. And the conversation you were talking about earlier, Andy, where Jeff Booth and the others we were talking, and Jeff was saying, this is a boardroom discussion at this point. And Jeff's a guy who sits on a lot of boards, and I'll tell you, he knows a lot of people, way more than I know, especially out in Silicon Valley, which in my opinion are going to be the companies that figured this out first. So, I mean, Apple, what is it, $200 billion of quote unquote fairly liquid assets on their balance sheet. I mean, you don't need much of anything going into Bitcoin. I mean, even if they did 1% or even 0.1%, I think the narrative that's associated with Apple buying Bitcoin and sticking it on their balance sheet is going to send a shot around the world to every other tech company in Silicon Valley that has any type of free cash flows. And let me tell you, the Googles, the Amazons, they're not going to just sit back and say, well, let me think about this. We've got the smartest software engineers on the planet that work for these companies, and they're now allowing this to flow onto the balance sheet. They're saying that there's something here. Come on, man, get out of here. Like that, them starting to put that on their balance sheet is just going to start something that I don't think anybody is prepared for, or that can fully understand the depth that it's going to bring. And from a legal framework, you talk about deep seeded entrenchment into the financial rails at that point. How in the world are you possibly going to start telling companies or anybody that there's restrictions on owning this and this and that? Because then it's going to turn into, you give it 1 quarter and you look at MicroStrategy's market cap after 1 quarter of this. Okay. And let me tell you, it's going to be a major discussion point as to how much exposure. The question is how much exposure should we allocate into this to remain competitive to certain companies? Because they're going to have the ability to go do acquisitions and all sorts of things that they just didn't have that flexibility to before, right?
Absolutely. Absolutely. And the MicroStrategy news came out. And again, your amazing episode that just came out, as you say, Jeff Booth said, yeah, the boards are talking about this. Okay. In my prior life, before I was a wealth manager, I worked at a hedge fund and I worked in private equity. So I was involved with a bunch of boards, actually. Went to a lot of board meetings. And I was thinking about this a little more. And what I realized was MicroStrategy took it all the way, right? They allocated, you probably remember the number, Preston, something like
250 million.
There you go. It's like a third of their cash or something.
21,749 Bitcoin.
Right.
21,000,
okay.
Sorry.
So that's a big move. That's a board level decision. But the other interesting thing to think about is what's not a board level decision, right? You got the board. Okay. You got the CFO. CFO either reports to the board directly or to the CEO. And then usually sitting under the CFO is the treasurer. Well, there are sort of materiality limits, right? In other words, yeah, you probably got to go to the board if you're going to put a third of your of your treasury in Bitcoin. But what if you just want to put 1 or 2% of your treasury in Bitcoin? That doesn't have to go to the board, right? That's probably a CFO, level decision, or even a treasurer level decision. The treasurer may have delegation authority from the CFO, who has delegation authority from the board. Yeah, you want to put 1 to 2% of our treasury in some other form of money, than dollars, along with the euros and the yen and whatever else we're holding. Sure, go for it. Now, those things won't get announced necessarily, right? Because they're not material, at the shareholder level. But you may see basically unannounced buying that doesn't even require board authorization. So that's incremental demand potentially.
So this is the part that so few, in my personal opinion, get with this MicroStrategy deal. So it was a publicly traded company, and that's why I think it was so weird to see what we saw play out, that they stuck so much of this into Bitcoin. Well, when you start digging into the voting rights of the equity, Michael Saylor had a complete control of the company. He can make whatever decision he wants, and all the other shareholders can do nothing about it because he has majority voting rights. So that's why you saw him take such a drastic position. All these other publicly traded companies are going to be tied down into these audit boards. They're going to be way more conservative. They're just not going to be able to do that, most likely because when you're dealing with publicly traded companies, having a shareholder like Michael Saylor, where he has a controlling share of the entire business, is very rare. Now, when you get into the private equity market, okay, guess what? It's not like that. And guess what? They don't have to report what's on their flipping financials to the public. Okay. I have my own business. Why do you think I've been talking about this for the last 6 months? Right? I mean, come on, because I'm doing it. Right. So here's the other thing that people don't realize. So let's just say that this stock to flow model is right. Let's just run down this path. Okay. And Michael Saylor dropped $250 million into Bitcoin. Okay. That means that his company could 10x the balance sheet for that Bitcoin that he's holding could 10x, okay, within 12 months, okay, based on the stock to flow value model, 10x. Now, for a company like his that's banging out $30 million on an annual basis, bottom line, net income, they're making $30 million a year. How long does it take MicroStrategy to make that much money that he just made through his Bitcoin investment? How many years does he have to sweep that net income into his retained earnings onto his balance sheet? How many years? You're not going to believe the number because I've done the math.
I think I can do the mental math. Yeah, go ahead.
83 years is how long it would take that company to collect that much in retained earnings. They'd have to do 83 years of business to make that much money. Okay. So now when you think about what that allows his company from a strategy standpoint to do, dude, he's in a completely different category from a business standpoint. He can go out and buy like a majority of his competitors in the space. He can go into whole different avenues. He can start going upstream, downstream into their product mix, right? And this is a company that has very stagnant net income. They have, for the last 10 years, their net income has not really changed at all. So to capture 83 years worth of retained earnings in a year is, for a company of this size, this is $1 billion company, is mind blowing. I mean, you can't even fathom something like that. The war chest that gives you is unimaginable. Now, for somebody listening to this that's skeptical, they're obviously saying, well, yeah, but all that stock to flow stuff has to come true. You're 100% right. But in my opinion, that's a way higher probability than people realize. And obviously Michael Saylor thinks the same.
I mean, we've also got, there's a bunch of buzz. So we've got, Fidelity and institutional, like on-ramps coming in, continuing to come in. We've got, reserve assets on corporate balance sheets, as, obviously MicroStrategy is the biggest news, but a couple of small businesses have come out and say that they're doing the same thing. If we do get continued price appreciation over the next 6, 7, 8 months, like that's just going to continue. It's a self-reinforcing loop. Price goes up, more businesses, start to invest or diverse their cash supply into Bitcoin. We had George Gammon on a couple of episodes ago, and he's down in St. Bart's right now, which is, an island full of hedge fund managers basically. And he's like, when we go to parties, after, we talk about the markets and whatever, the people really want to talk about is Bitcoin. Like the night kind of settles into talking about Bitcoin. And, here's a tweet from this guy, JP, Dangerous Freedom on Twitter. There was a thread about, high net worth individuals and getting into Bitcoin. This guy says, yes, I can confirm I'm in Silicon Valley, LA, ultra high net worth space. And we just got the green light to start selling clients Bitcoin. We have around 50 million in total commitments thus far, ranging from 100,000 to 5 million in size. Some of the names buying Bitcoin would definitely make the news of public. So, there's all these rumors around high net worth individuals as well piling in. What are you guys hearing? You guys both have your ear to the ground in different ways in the finance world. Is this something that you guys have caught wind of as well?
Yeah, it's definitely around, and there's definitely conversations being had. In one respect, I'm tainted, right? Because I'm I'm like one of these rare guys in the wealth management business, who's been pounding the table when I shill my book. And so, people have already heard it from me, if they're talking to me. So that may sort of mute the signal. But I will say that for me, again, I return to that hard money thesis, right? I'll say one thing that's new, for me in my business, well, somewhat new, which was, we started buying gold in 2016. And then obviously we discovered Bitcoin and started buying Bitcoin. But the asset allocation, we have asset classes, right? We have, US stocks and foreign developed stocks and emerging market stocks and various classes of bonds and fixed income. And for the first time in the history of our firm, which is 32 years old, we have an allocation to what I call hard money assets, right? And hard money assets are the monetary asset that's hard to make more of, that's hard to produce, that's hard to print. Now for us, for the world, that's historically been gold. But as we see, Bitcoin's just going to eat away, market share from gold, right? It's going to be inexorable, and it'll be, cyclical, and there'll be accelerating rates. And I'm on Preston's team with respect to this is probably going to be a monster. The next 12 months, 18 months for Bitcoin, I'll be surprised if it's not a monster year and a half for Bitcoin. But yeah, the hard money asset thesis is what I've found resonates the most. This is going to sound crazy to a lot of listeners on this call, right? But there's plenty of investors, there's plenty of wealth managers who don't even own gold. Now, listeners will say, well, gold's obsolete. Okay, fine. I happen to believe that gold's going to do, going to do fine probably in the next 5 years. But what I'm trying to tell you is there's many investors, Preston knows as well, who understand buying cash flowing assets like Warren Buffett, and they don't understand buying non-cash flowing assets. Like, that's anathema to them. So there are some people who were so far behind that they couldn't even get, their heads around sort of the Austrian school concept of monetary asset that will survive, the coming inflation. And they're just getting over that hump. And now they're trying to get over the Bitcoin hump. So it's coming from all angles. You've got guys who just got into gold who are now sniffing around Bitcoin. You've got people who are, really have actually done their homework now on Bitcoin and are allocating. It's usually fuzzy numbers. I mean, you don't get hard number disclosures generally of what people are doing. But yeah, I'm seeing it all around me. I'm hearing it that people are keying into hard money assets, and they've started to figure out that Bitcoin is the hardest and the best of the hard money assets.
Brady, like you, I've heard some pretty big names out in the valley, and I'm not at a position to be able to name who these people are in a public forum, but the rumors going around are people that everyone knows that are taking positions. And from what I understand, they're taking positions privately. I have not heard anything obviously on the corporate side, but I mean, come on, if you're running a big multi-billion-dollar company and you're taking private positions, darn well they're talking to whoever they are at their company to say, all right, well, what do we got to do to put this on the books? So yeah, we'll see. I mean, it's all rumors at this point, but I think in the coming quarter, I think in the coming 3 months, we're going to have a much better idea as to whether these rumors are true.
We'll see it in the price.
Yeah.
Well, let's talk about that. I mean, because a lot of these people are getting in, through, like, not with the base asset, like through futures or something like that, right? So, like I know Luke Rahman talks about this, and I think maybe you even did on the episode you did last week, or wait, maybe it was earlier this week. But that episode was amazing. Everybody's got to go and listen to it. The Investors Podcast with Lynn and Luke and Jeff. It was incredible. So anyway, Luke thinks that, these paper instruments hamper the true price of gold. Should we have the same concerns that, about Bitcoin, basically, that this could happen? That
I love this.
Yeah,
I love this question. I really want to bite on this one. So here's the difference. So you can play the game. So this is for people that aren't familiar with derivatives, right? You can, if you're a government entity or whoever, and you got deep pockets, this is how you can understand how you can manipulate a market through derivatives. Everyone's played a game of poker, right? You've played a game of poker. And when you play a game of poker and somebody says, hey, unlimited buy-ins, right? Unlimited buy-ins. If you run out of money, you can buy back in and you can keep on playing. That's what the derivatives market can do to the price of something. So if you have really deep pockets, if you're playing poker with a billionaire and you have an unlimited buy-in, are you going to win? That person could be the world's worst poker player. They're going to beat you because they can keep buying in and they can keep adjusting and doing that. That's what the derivatives market can do to something. Now, where I think that Bitcoin is very different from normal markets is that it can be settled in Bitcoin digitally. What other asset or commodity on the planet can you do this? Where you can settle, you can deliver the item at hand digitally. Okay. That's where I don't think this plays out anymore. It's because you do have Bitcoin settled derivatives. I think it blows the lid off of that situation now, because, if I say, hey, give me my Bitcoin, I want it delivered right now, and here's the address to deliver it. It's not like I have to have some port open in New York City in order to receive so many bushels of whatever, right? that is gone. So that changes the whole dynamic of, and I said that to Luke one time. This was not on that conversation. He brought his narrative to that conversation, and I didn't bring it up. But I said that to Luke one time, and he kind of looked at me. He goes, I'll have to think about that. But that's my comeback to anybody that's saying that is, hey, you got physically settled Bitcoin derivatives, which I think changes the game, man, in a major way.
Yep. I think that's a very interesting perspective. Yeah. Gone are the day. Well, I shouldn't say gone are the days, but yeah, having to take delivery of those barrels of oil, or having to force someone to deliver physical, there's not a lot of barrier between delivering, quote unquote, delivering physical, right? It's like, okay, go log in, sign the transaction, send me the Bitcoins. It's pretty simple. Yeah. The second thing I'll say is, here, Bitcoin's volatility, price volatility is our friend, so to speak. And I'll explain why. So when the futures first came out, and I don't remember if it was SIBO or CME, and it's been, I don't know, Preston, you probably remember, it's been 18 months now or 2. No, I guess maybe it was late 2017 that the first futures contracts came out on Bitcoin.
It was like November, I want to say, of 2017.
Right.
And you saw a lot of people attribute the crash to the derivatives. And I'm thinking,
that's right.
That is not what you just ran out of more participants on the network.
Yeah.
In my opinion, what happened there. Yeah.
That's right. Okay. So it was late 2017. And then it was the ICE, right? Intercontinental Exchange came out with their futures product, or they announced it, in the summer of 18, but it took them, I don't know, 16 months to roll it out. It took a while. I don't think it's gone too far. Okay. So what happened was Interactive Brokers, okay, $22 billion publicly traded, big brokerage firm, right? One of the majors, run by this guy, founded and run by this guy, Thomas, I think Petterfy is how you pronounce his last name. I'll never forget an interview he gave. Someone was asking him, hey, are you going to support Bitcoin futures, right? And he said, yeah. And they published a letter on it too. But we are going to require, 100% cash collateralization, right?
Yeah.
Why? Because Bitcoin is, as Preston might say, flippin' volatile, right? It is, the price can move a lot. So what does that mean? Well, if you are on the long side, okay, you've got unlimited upside, and then on the downside, you can lose all your money, so to speak, but you can't lose more unless you're using leverage. But if you're on the short side of the contract, man, you can get REKT wrecked, right? And so what that means is participants in the market, brokers, custodians, counterparties, they're not inclined to allow high leverage on these things. Now, sure, certain unnamed exchanges, possibly domiciled in the Seychelles, may allow, leverage trading on Bitcoin. But when you talk about the larger entities and the institutions, or let's say the powers that might be assumed to, quote unquote, manipulate the market downward using derivatives and specifically futures, those guys are scared. They're scared of the vol in this thing. And so they're less likely, those counterparties are less likely to allow significant leverage. And moreover, anybody who's interested in manipulating the market knows that Bitcoin can go up 2-3x in a very short period of time. And if you're on the short side of that trade, you're toast. So the very nature of Bitcoin as it relates to its volatility, as well as what Preston pointed out, the potentially more or less instant settlement, makes Bitcoin a different animal as it relates to, shadowy powers behind the scene trying to manipulate price downward, in my opinion.
So here's what I love about derivatives in Bitcoin is, like Andy just described, so I own some call options, right? Not a big position relative to of just owning outright Bitcoin for many reasons, mostly the custody risks and things like that. But I own some call options, long-term call options, right? Maturing in December of 2021. So for the person who wrote that contract that I purchased, they had to cough up a full Bitcoin to write the contract for one Bitcoin having that call, right? For however many calls you buy. So now think about what that does. So let's say Brady wrote the contract. He has to take a Bitcoin. He has to put it into their custody, lock it up behind key until that contract matures in December of 21. So when we're thinking about supply, right, what does that do to the supply of Bitcoins that can now be traded on exchanges? It's not there anymore. It's sitting in some locker until December of 21, right? And you got people buying the living hell out of these things. And they're doing it on the short end too. And so like, I love the derivatives market. It's just locking up coins because you're talking about the volatility. Well, what do people want? They want a whole coin in there if they're buying a contract for a whole coin. And so, I mean, it's exciting.
It is. And that's right. I mean, that's how the way the prime brokerage, business works at institutional scale is on normal, quote unquote, normal assets, regular way assets. What Preston described as, writing a covered call, right? Some counterparty, owns a Bitcoin and says, yeah, I don't think it's going to make it to, 100K by the end of next year. So I'm happy to write Preston this contract. He'll pay me the premium. And, on the off chance that he's right, okay, he takes my Bitcoin and makes profit, but I don't think he's likely to be right. Now, because of the huge potential volatility in Bitcoin, anyone who's involved in this trade is going to do what Preston describes. They're not going to write an uncovered contract. And moreover, whoever's the custodian or prime broker sitting in between it isn't likely to let him do that. This isn't true in, equities or, the treasury market or other major markets, right? You have hedge funds, especially some individuals as well, although it's harder to get as much leeway, let's say, from your broker. If you're an individual, you got to have a lot of assets. But if a hedge fund wants to basically write an uncovered option, on some asset, I don't know, the S&P, what have you, the prime broker will look at the risk assessment and they'll look at the expected volatility of the underlying asset, and they'll say, yeah, if you post X amount of collateral, chances are you're going to be fine, right? Even if the underlying goes up by 20% or goes up in a significant way in the meantime. But man, you can't. I agree with Preston. I doubt that there's much uncovered call writing in the Bitcoin space, or will be anytime soon.
Yeah, because there's no way I would buy that contract unless it was
right.
Because there's too much opportunity cost of just owning the underlying. Because now you got to, because the other consideration to these that I'm obviously doing is the tax piece to it. So if I'm not holding the call for more than a year, well, then I'm getting into a short-term capital gains tax. And then I've got to be exactly right based on the strike and like all those dynamics. And this is why I tell, if you don't understand this stuff, like you should not be doing any of that stuff. You should be setting up an account at Swan and doing your monthly buys, right? Like this is more like graduate level stuff that when you're talking about the upside that we're talking about here, you're just getting greedy. And that's why I would tell you the position size that I'm talking about is very small compared to the position that I have just in the underlying Bitcoins that you take your own private keys, for. But the reason I guess we're talking about is because we're talking about the supply of the coins. We're talking about how the rest of the finance industry is looking at this and how how are they going out and providing interest rates at 5 and 6%? Well, they're doing it by buying Bitcoin, stepping into the market, writing that call contract that I'm then buying, right? And then they're buying a put position at the same strike to protect their interest. They're maybe capturing 10% or whatever it is. They're giving you your 5% and they're keeping 5% for themselves. That's what's playing out. And people just don't understand all those dynamics. But your financiers, that's how they're playing it. And that's what they're doing. And their risk exposure, even though they're giving you 5%, is literally nothing because they wrote the contract and they bought the put. So they're there covering themselves. There's just that spread dynamic that's playing out that they can capture that and offer that yield.
Yep. And just to augment, well, first of all, Preston, I'm sort of jealous of you for putting on the, the long-term call. That's the trade, that's the trade that, there was an opportunity a few months ago. I mean, obviously, when Bitcoin really tanked, there was an opportunity, but there's an opportunity in the summer when those calls were quite cheap. And I kicked myself for not making that trade, that trade myself. But your advice is good, which is for most listeners, you can make plenty of money stacking your sats, plus buying the dips. There's no real need to get greedy if it plays out as we think it will.
So I'm going to work in a question here from YouTube. This is from Jack. And it's a good one. I mean, we've spent this episode being pretty damn bullish about Bitcoin, and we're out on Twitter all the time talking about all this big news, and it feels like all the stars are aligning the way that Bitcoiners had anticipated that they would. But Jack wants to know, what is your biggest concern when it comes to holding Bitcoin long term? What's the downside? Preston, you want to start with that one?
I'm sorry, I was responding to somebody who
no worries.
Had a
Andy,
comment.
Are there comments
nice.
I should be responding to?
Are you in the YouTube, Preston?
Yeah.
Nice. Okay. So the question on the table then is what's your biggest concern when it comes to holding Bitcoin long term? I'll let Andy start.
Yeah, biggest concern about holding Bitcoin long term. So I'm actually, the longer term we talk about, I'm probably the less concerned I am, right? I mean, we can go through the whole laundry list of, risks and, how could it die? Someone discovers a bug in the code, or, someone somehow manages to bootstrap and, an even better, harder money, internet money based system. These are all possibilities. The one thing I look for, well, actually you asked Brady, I think earlier, what are sort of the current indicators we're looking or things we're monitoring. Obviously I'm monitoring, government rectitude, right? What would be bad news for Bitcoin? Oh, they stopped printing too many Shroot bucks.
Yeah.
Right.
That.
If they actually stop running deficits and stop monetizing deficits and pull the supply, of money in, such that the dollar becomes, harder than gold, right? That the inflation in the supply becomes lower than that of gold, or even goes negative. Then I'm worried about Bitcoin. But absent something like that, it's, as you like to say and others like to say, Brady, TikTok next block. If the thing keeps cranking out blocks, and as Preston, points out, if the hash rate, basically keeps going up over time, and they keep printing the money, and the debt, is still high and rising, it's hard to see, what the major risks are in the long term, other than the, esoteric, we don't, there's quantum computing and we don't get to a quantum hard, system. And I don't want to spend 20 minutes talking about all those, possibilities. Yeah. So I'll leave it there.
I think that's the biggest risk, Brady, is if elected officials start becoming very fiscally responsible, it's not going to be good for Bitcoin.
Yeah.
So if you're concerned about that, then Bitcoin probably isn't the place to be. Now, I will answer it a little bit more seriously. It goes back to what I was saying earlier, which is if I see that the hashing rate start to shift, or it looks like miners are not profitable, and you start to see them shift, that's whenever I have a lot of concern for the protocol. And we're not near anything like that. And I want to read this quote. This is a Satoshi Nakamoto quote from 2010. The quote says, "The price of any commodity tends to gravitate towards the production cost. If the price is below cost, then production slows. If the price is above cost, profit can be made by generating and selling more. At the same time, the increased production would increase the difficulty, pushing the cost of generating towards the price. And that quote for me sums up why stock to flow is valid. Because what you have is you have this quantum leap that happens every 4 years. It reduces that flow. The miners are mining that. They're taking their fiat dollars that they're expending. They're getting reward. They're receiving payment onto their balance sheet of Bitcoins, which they then have to sell in order to pay those fiat bills. So all they're doing is they're effectively executing killing fiat dollars through this mechanism of proof of work. And the price is getting polarized to that production cost. And I think that, and I'm not saying that when the stock to flow for this next orbit is 100K, that's the production cost. The production cost will be slightly underneath of that. But for simplicity, you can just think of those levels that the stock to flow is pumping out as being those production costs of the miners, right? It going to what that quote is. And so you can see when you look at that quote and the vision that he had for how this was all going to play out and how this is effectively a time fuse for entrenchment into the existing financial rails. And I think that's why you see the 4-year cycles. That's why you see the thing playing out the way it is because he knew the only way something like this, or I say he, she, whoever, group of people, whatever it is, they knew they needed entrenchment. They knew that it had to happen over a decade or whatever that would be. I fully believe that, based on some of this stuff, I think this person was a total savant, whoever they were, in understanding scarcity and understanding commodity prices and understanding a lot of these things that are totally built into this incentive structure. Now, what would cause that to unravel itself? What would cause that to unravel itself is if there was not demand for the service and the product that, or the commodity that's being pumped out. So what would cause an organization to move to something else? Well, if there was something that provided better decentralization, you might see them move to that coin. If something provided better security for the transaction, for the storage that you're putting into this. So like if I'm storing 1 Bitcoin, how much security is associated with that? Okay. So if another protocol comes along and provides better security and storage capacity for the value I'm storing, well, that protocol could take off. So when I look at those metrics of why demand would go somewhere else, that would prove that quote wrong, because then, this is getting into the labor theory of value is that quote. And people say, well, the labor theory of value is invalid. That's an Adam Smith thing. Right. And I would counter that. I would say that it is valid as long as there's demand for the work that's being performed. And as long as you're dealing with something that is commodity-like, which Bitcoin is. Okay. As long as those things are valid, I think that quote remains true. And I think that's what we're seeing. And I think that's why we're seeing the stock to flow valuation continue to play out exactly like it was published.
Yeah, I think that's a very insightful view. One other thing just occurred to me, and this gets back to, Preston, who's rightly, you're rightly laser focused on the key performance indicators, right, of the network itself. One thing that would concern me is if you saw, node count, fall precipitously or continuously, over time. And I guess I'd have to say, visible node count plus, we make some assumptions, or we have some indication that, Tor nodes or hidden nodes are, for whatever reason, also in decline. What, how or why that would occur, I don't know. Everything about computer science and, things like Moore's law tells us that, as compute gets better, faster, cheaper, it'll be easier and easier to run a node, right? Eventually we'll all have them on these things. And so, that eventuality is sort of hard to fathom. It seems extremely unlikely. But, if I had to imagine a scenario or a key performance indicator that would sort of give me concern and might actually feed back into demand, as Preston's talking about. In other words, people start to look at the thing and they say, let's say it's a couple trillion or a few $1 trillion of value on the network now. And then people see the node count reverse. And then they say, well, I'm not as sure about the decentralization now, or not that I'm not sure about it, but I'm not like, maybe I'm $3 trillion sure, but I'm not $50 trillion sure. Right. So, but that seems highly unlikely to me.
And I agree, but those are the risks, right? We got representatives become fiscally responsible. We have some of the things we just talked about. Those are the risks. People want to hear, well, Preston, how could you be wrong? That's how I think I could be wrong. You tell me what else I'm missing, right? Because I can't pin down anything else.
Yeah.
Yeah. I mean, there's just not a lot of downside. We've been thinking about this for years and years and debating this. And I mean, obviously all the FUD, comes at you from the skeptics. And we've spent a long time looking at it from every direction. And, just Bitcoiners in general, especially developers and cypherpunks, are adversarial. They think in adversarial ways, right? They put themselves in your adversary's shoes and, cut off the attack wherever possible. I mean, and there's a famous, I think it might have been Dan Kaminsky, he was a famous a hacker, and he was asked to audit the Bitcoin protocol, the code. And he said that every time that he thought of a way to attack the protocol, he would go to that spot in the code and there would literally be like comments like, removed this potential attack vector, stuff like that. So Satoshi's like, all over it. And it's only, improved since then, leaps and bounds. So, all right, well, we're at time. That was a lot of fun. I really appreciate you guys coming in and hanging out and talking some Bitcoin. It's super exciting times. And, I hope you guys come back relatively regularly, and we'll just kind of keep checking in on all of our predictions and hopes and dreams for this new money, this wild ride that we call Bitcoin.
Brady, I appreciate the opportunity. Andy, such a pleasure. Been following your Twitter for quite a while now, so it's nice to chat with you, and really appreciate the engagement with the audience and the questions in there. This is always so much fun for me to learn, to see the questions, the important questions that I think we got to continue to troubleshoot. How could we be wrong? What is it that we're missing? What aspects can we add to the idea farm of all the technical people that are truly the ones making all of this happen from a programming standpoint? And just it's really exciting to be a part of this community.
Well, Preston and Brady, I really appreciate you guys spending some time with me here. Preston, yours is is basically the go-to Twitter account, plus podcast for me on general investing. Brady, always a pleasure, man. You're doing great work. How many pods are you running now, by the way? At least two.
At least two, and I think you made another one for me recently, right?
Yeah, we can talk about that one offline. So I really appreciate you guys coming on, and I'm still learning, and I learned some today, and I hope our listeners and viewers got something useful out of it.
Listen to the Investors Podcast, buy Andy's book, Why Buy Bitcoin. Go to swanbitcoin.com and start stacking. Daily buys, again, swanbitcoin.com/daily buys. Get in on that group. We're going to be rolling that out soon, and would love to have your input as one of the first adopters of daily buys. And one more shill, this cool little pin, thanks to btcpins.com for making these. They've got several others, just kind of launched their business, but really cool designers. There's a couple other designs out there too, really cool open dime pin that looks pretty rad, just like a real thing. So check those out, btcpins.com. All right, thanks everyone, appreciate it. See you guys next week.